Hello, everyone, and welcome. With the new Income Tax Act 2025 now in effect, it's absolutely crucial for us as tax professionals to get a firm grip on the revised provisions. So today, we're going to do a deep dive into one of the most common heads of income from house property, covering the brand new Chapter IVC, that's sections 20 to 25.
So let's just jump right in with a practical situation. Let's say you own two houses. You live in one, but the other one is completely vacant for the whole year. Now, under this new act, are you going to be taxed on that vacant house? It's a question I get all the time, and I promise you, by the end of this explainer, you'll have the answer. No doubt about it.
So here's how we're going to break it all down. We'll start with the basics, the new charging section. Then we'll walk through exactly how to calculate the annual value. After that, we'll get into the good stuff, the deductions. We'll also touch on some special cases like deemed ownership, and we'll wrap up with some really practical tips and the key takeaways. All right, let's start at square one, the foundation. This is the charging section, the provision that actually pulls income from a property into the tax net in the first place.
So, Section 20 of the new act tells us that for this to even apply, three core conditions have to be met. First, and this is important, the tax isn't on the rent you actually get, but on the property's annual value. Second, the property itself has to be a building or land connected to it. And third, you, the taxpayer, have to be the owner. If you can tick all three of those boxes, then yes, the income falls under this head.
Now, for all of us who have lived and breathed the 1961 Act, this slide is your new best friend. It's a simple map from the old section numbers to the new ones. As you can see, the concepts are familiar, but the numbers have all shifted. The old section 22 is now 20, 23 is now 21, and so on. It's a simple change, but you've got to get it right.
And speaking of changes, here is a fantastic simplification in the new act. Remember the whole previous year versus assessment year confusion? Well, it's gone. Now we have one single clean term, tax year. So the income of a financial year is assessed for that same tax year. It just makes everything, from records to communication, so much simpler.
Okay, so since the whole basis of the tax is this thing called annual value, our next job is to figure out how on earth to calculate it. And that's all laid out for us in Section 21.
The process for finding the gross annual value, or GAV, is basically a four-step dance. First, you figure out the fair rental value, the municipal value, and the standard rent. Now, your expected rent is the higher of fair rent and municipal value. But, and here's the catch, it can't be more than the standard rent. The final GAV is then just the higher of that expected rent and the actual rent you got.
Once you've got your GAV, getting to the net annual value, or NAV, is super easy. You just subtract any municipal taxes for the property that you, the owner, actually paid during that tax year. That's it. This NAV figure is the magic number that we'll use for calculating deductions.
And now, we're back to our very first question. This is where it gets really interesting. The new act continues a huge relief for homeowners. You can claim a nil annual value for up to two properties that you're living in yourself. This is a massive benefit, and it directly answers our question. Your vacant second house can be treated as self-occupied, meaning no tax on it.
Okay, so we've got our net annual value. Now let's get to the good part, how Section 22 lets us shrink our taxable income even more, with a couple of key deductions. The first deduction is a complete no-brainer. It's a flat standard deduction of 30% of your net annual value. This is supposed to cover things like repairs, painting, you name it. And the best part? It doesn't matter one bit what you actually spend. Even if you spent nothing, you still get the full 30% deduction. Simple as that.
The second big deduction is for interest on borrowed money. If you took out a loan to buy, build, or even repair the property, that interest is deductible. And the law is pretty smart about this. It even considers interest you paid before the construction was finished, what we call pre-construction interest. That amount gets spread out and claimed in 5 equal yearly chunks, starting from the year the house is ready.
So apart from the normal calculations, the Act has some special rules for trickier situations. Let's quickly look at a couple of really important ones in Sections 23 and 25. The main thing to get from Section 23 is all about timing. Let's say you finally receive some rent from a previous year that you thought was lost. Well, it gets taxed in the year you actually get the cash. And this is true even if you've already sold the property and aren't the owner anymore. When it comes to arrears, it's all about the year of receipt.
Now, Section 25 introduces this fascinating idea of a deemed owner. And you might be wondering, why do we even need this? Well, it's a powerful anti-avoidance tool. It stops people from just transferring property to family members in a lower tax bracket to avoid paying taxes. So for instance, if you gift a house to your spouse, the law says, nice try, but for tax purposes, you are still the deemed owner, and you're the one who pays the tax.
Okay, we've covered the law. Let's switch gears and get practical. Let's talk about compliance, paperwork, and some of the common mistakes that you really want to avoid. Look, if you want to stay compliant and be ready for any questions, your documentation has to be perfect. It's just non-negotiable. So here's a quick checklist. Have your registered rent agreements, keep those receipts from municipal taxes, get that annual interest certificate from your bank, and of course, have your title deed to prove you're the owner. Let's quickly flag a few common tripwires. A really frequent mistake is messing up the 5-year calculation for pre-construction interest, so be super careful with the start date. Now here's a massive transition tip. Any house property losses you are carrying forward under the old 1961 Act can still be set off under this new Act. That's right, your old losses are safe. And finally, just a word of caution. If you own, say, 3 or 4 houses, be very deliberate about which 2 you choose as self-occupied to get that nil value. All right, we have covered a ton of information. Let's take a breath and really lock in the most important things you need to remember from this new chapter.
So what do you absolutely need to walk away with? First, the taxes on the annual value, the property's potential to earn, not just the rent you pocket. Second, your 2 biggest weapons for reducing tax are that flat 30% standard deduction and the interest on your home loan. Third, that benefit of declaring 2 self-occupied properties as nil annual value is a huge tax saver. And finally, always keep the deemed ownership rules in the back of your mind because they can create tax liabilities out of nowhere.
And that's our complete tour of income from house property under the new Income Tax Act 2025. I really hope this has cleared things up and, of course, answered our question about that vacant second house. If you found this useful, please do me a favor and like, subscribe, and share it with your network. Thank you so much for watching. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.